right, gents, ready?
Ready.
Hi, I'm Tobias Carlisle. This is a brand new podcast. We don't know what it's called. We're thinking After Hours, but if you've got a better suggestion, let us know. I'm joined by my regular co-hosts, Jake Taylor, author of The Rebel Allocator. He got a telephone call from Charlie Munger. We're going to talk to him, hear about that right after this. And then my third co-host is Bill Brewster, Sullimar. I can never say it correctly. How do you say it, Bill?
Sullimar Capital Group.
We're going to talk to each other right after this.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, we will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
Gents, anything interesting happened this week? Oh, this is gold. This is absolute gold.
Yeah, nail it.
It's like, when Seinfeld started and you kind of like the first season, you knew it was going to be good, but they didn't quite understand when to come in. We're just ironing out the kinks.
Yeah, for sure.
It's all going to click.
I think that sounds great. Let's talk about the Rebel Allocator and getting a telephone call for Charlie Munger. So anybody who hasn't heard that story, let's hear that story, Jake. That's a great one.
Okay, well, I'll give the quick version because even I'm tired of hearing about it at this point. But I wrote a book that basically tries to teach some of the lessons of capital allocation through a fictional story, and Munger and Buffett obviously factor heavily into it because they've been so prolific in teaching about all kinds of topics. But I sent Mr. Munger a copy of the book, and maybe about a month later, I get a phone call at my office, and it turns out it's Munger on the line, and he wants to talk about the book. And his biggest thing was that he actually wanted to encourage me to get it made into a movie, which is its own kind of daunting project.
Where's that up to? Is that happening? Is that in train?
There are some developments at this point. Maybe some screenplay.
Wow.
Writing happening. Not by me, but I'm helping a little bit with someone who's more talented than I am. So we'll see. That whole thing is so far outside of any of my area of expertise that I don't even know what's right or wrong, but it's fun to work on it. So then Charlie, just to wrap up the Charlie story, he wanted, he's encouraging me to get it made into a movie, and he also had some comments about maybe looking a little bit more widely as an investor and don't try to fish where everyone was fishing, and that kind of turned into a funny story in the Wall Street Journal about calling all of us value guys cod fishermen, and so I think we're there's a bunch of cod fishermen on this podcast right now.
Was that Jason Zweig?
It was, yeah.
Cod fishermen. That's probably fair for value guys.
Yeah, I didn't take umbrage to it too much, but it's definitely it does highlight an interesting, I think, phenomena that maybe we'll get to at some point during this podcast, where we have the information now has gotten so readily available that, if you were just a value guy in the 60s, even just looking through the numbers gave you such a huge advantage. And now it's gotten much tougher now to really try to find value that other people aren't finding.
Well, that's the kind of the informational argument for value, right? But is that I lean more heavily on the behavioral. I think that, and I always bring it up, and I should get John Huber on the podcast at some stage, but John Huber wrote this great piece where he talked about, even in very large cap companies, they vary from 2/3, like 30%, tripling over the course of a year. And he gave the example of JP Morgan, which I don't think it backed off at all through 2007, 8, 9. It might have had a couple of years where it didn't grow book value, something like that. But the share price was wildly all over the place. And if you just kept an eye on even book value, as unpopular as that is, but that's probably a pretty good way of valuing financials, valuing banks. If you kept an eye on the book value, you bought it at a big discount to book value, you've done really well.
Yeah, well, I mean, look at Apple since December, right? I mean, you're going to tell me that that company has changed 70% in value? No way.
It just goes to show what a goat Buffett is, backing up the truck and buying a ton of it when it was down like that.
He's a beast. I mean, I think the thing about that is it's always easy in retrospect to be like, oh yeah, that was a buy. Pulling the trigger and catching a falling knife, and knowing when it's not a knife that's going to stab you and when it's a butter knife or whatever, I mean, that's like what makes the greats, I think. So
how do you do it? What's the secret to that?
TBD, man. I'm still working on it, but I mean, for me, I got more lucky than good, I'm sure, right? In December, part of it was watching, like I said, part of it was being lucky, and part of it was like, this is panic right now. And the stuff I'm buying, I'm comfortable owning, right? Like the cash flow underlying, even if I have to wait a while, like especially with Apple, you're going to benefit so much from the buyback if the shares go down. I actually just let go of it today. It's the capital return story doesn't go as far at these valuations. And I don't know. I mean, I'm even having a little seller's remorse, right? But like, it was so much easier to identify that it was cheap then. Was it right to sell? I mean, I don't know. That's a sort of a harder question to answer, but we'll see.
Well, they're two sides of the same coin. But buying is hard, but selling's even harder.
Yeah. Yeah, that's like Munger says, right? He's like, I'm good at buying, I'm not very good at selling. I feel like I probably suffer from the same thing.
The people who are best at selling never sell. You just hold on to it. A decade later, you're like, oh, we're up 1,000%.
Yeah.
I think that's one of maybe the secret sauces of Berkshire that doesn't get talked about enough, is that constant replenishment of cash coming into the inside of the company. They never really have to sell anything if they don't want to. And there's always new money coming in to buy the next interesting idea. Like that, what a huge advantage compared to when you're, if you're managing a fixed portfolio that you have to dump something, that can give you a lot of remorse.
Well, yeah, Markel benefits from that. Fairfax to a certain extent too, right? I mean, I think Markel's philosophy is closer to, we're going to focus on companies that are quality, and we're going to sort of, we'll maybe buy a little bit more when we think they're cheap. We'll maybe dollar cost average throughout. But like, I almost think of that portfolio like a levered quality portfolio. And, I mean, over time, if you have strong underwriting and you're reasonably good at identifying, when to buy something, which they obviously are, I mean, you would think that that's going to be a powerful engine.
That was AQR's analysis of Buffett too, wasn't it? That he was 1.7 times levered to the quality factor, I think, and there was very little value in there, which is surprising to me.
Well, it's so different from the partnership days, right?
Right.
At least from what I understand.
Very much.
Yeah, that's right. When he needed to make the money, he was like a value guy, right?
Buying it like a net guy, a liquidation investor, if he needed to be, like a pretty hardcore activist who actually went in and shut down the business and liquidated it, even though the townsfolk were upset about it and they were writing letters in the little local newspaper.
Don't ruin his image, Toby. Come on.
Yeah. My
Corporate
favorite
rate
story
of
of that was from when he just he painted a line inside of the warehouse and said, like, if you don't get the inventory below this line, then everyone's fired, basically.
We're going to shut the business down. Yeah, was that the first? Was Harry Bottle the man who had to do that?
Yeah, that was the Dempster Mills activist position.
So while we're talking about value, this was my topic for the week. I've been kind of collecting these things on Twitter and I've been pumping them out. It just seems to me like there's a crescendo of guys out there shouting about the fact that value is so vastly underperforming momentum or glamour or growth or whatever you want to call it. And that the spread, however you measure it, is now sort of, it's not quite at 2000 levels, but, so AQR, Cliff Asness had this piece that came out last week, I think, where he said, you're basically now faced with the prospect of value has two sort of paths. Either it's going to blow out to .com levels, which is possible but unlikely. And if you exclude the .com, period from the data, then you're in like the 100th percentile for value underperformance, which would seem to suggest to me that it's pretty stretched, and we should be going into, if not, immediately, if it hasn't already started, which I think there's some possibility that it has. We're going to go into it soon. We're all value guys, so we're all talking our book, but how does that strike you?
You go first,
You
Bill.
want it? All right. Well, so
nobody wants to jump on that grenade.
No, I'm fine jumping on it. I'm sure, I don't want to upset Compounderville at all. But, so Jake and I participated in a weekend where we got together to talk about subscription businesses or recurring revenue. And Jake's comment was, this is sort of toppy if a bunch of value guys are coming together to talk about recurring revenue businesses, right? But the one theme that I think everyone could agree on is if the business was close to like a real recurring, I mean, CPG is sort of recurring revenue in its own way, right? But I'm talking something SaaS-y or Peloton.
For the folks who don't know, what's CPG?
Oh, like consumer packaged goods, right? Like
and SaaS is software as a service.
Yeah, that's right. So like the continual consumption of Diet Coke, I think, is pretty recurring. But the new sort of sexy version, these valuations that we were all talking about, I mean, we were all scratching our heads. So I don't know that value is the side of this that makes the alligator jaws collapse. I'm pretty sure that growth investors, like traditional, I don't even know what, top decile evaluations, I don't know that returns, very good returns unless you really are skilled at picking the right winners.
I'm going to take the contrarian view on this. I think, even though I would love to be rooting that like this is, the rubber band is stretched so far that it's time for value guys to come back to the, being heroes again. When I look at the relative valuations of, let's say, the cheapest 10% today versus the cheapest 10% in 99, those two baskets are completely different. The cheapest today are typically debt-laden, really poor quality businesses, and I'm fine buying things that are poor quality for the right price. But even then, the price is just relatively cheap to that most expensive today. It's not that cheap compared to the 99. And so, if I think about, kind of a GMO analysis of like, well, where's your starting price? And I'll kind of tell you what your future return might look like. I would more imagine like value putting up very small, maybe positive numbers over the next 10 years and everything else being bigger negative. And it's ready for outperformance, but it may not be the performance that you actually want. So to me, from these levels where we're starting, there is no real great outcome available. So,
I see the problem I see is that, I wrote a book ages ago, Concentrated Investing. Nobody's ever read it. It's not
somewhere on this bookshelf right here.
There you go. That's one of the people. That's one of the dozen people who bought it. One of the dozen copies. There's an interview in there with Glenn Greenwald, who's a brave warrior, formerly chieftain, and he talks about his methodology, or his method was he wanted a 10% free cash flow yield in the next 2 years. So what that means is he could buy at whatever, like 6 or 7% free cash flow yield, provided that he could see that there was this pathway to growing the business enough that in 2 years' time it would be at a 10% free cash flow yield. Now, if you're looking for a 10% free cash flow yield in this market, even one that's like a few years out, that's really, really hard to find, because that's, in my very deep value basket, my free cash flow yield in that basket is 10%, but the reason that it is that way is a lot of these businesses look like they're declining. So 10% is a very fat yield. What do you think?
Yeah, I mean, I agree. I think I like to think of investing as you have two ways out, right? You can have price appreciation to the point that you think it's sort of silly and sell, or you get paid back your cash flow. And one business that came up a lot this weekend is Rollins. They do termite. They kill termites. You're paying like 30 times earnings. So out of the gate, let's just assume for purposes of this conversation, earnings and cash flow are the same. I mean, the earnings base that you're paying for, you get a 3.3% cash flow yield. Now, yeah, the incremental dollars that they can deploy, you earn the business's returns, but it's not as if this is a tiny company. You have to wait a really long time to start to, they say it trends towards ROIC. I mean, that's going to take a long time. And I'm not sure that people fully understand that right now. I think, when the difference between a 3% discount rate and 2%, you can get a lot of price appreciation off that.
Why is a business like that defensible? What's the moat there? What's the competitive advantage?
I suspect it's like one of these local economies of scale, service-based things. You want a termite killed. You're not going to try to go to, I'm pretty sure they're Terminex. I'm not sure. That could be wrong, but I'm not sure that you want to have Toby and Bill's and Jake's. Sorry, termite.
I don't want into that business.
No, you're not into it. It's a great business.
What if it's cheap? What if we just come in at half the price?
I don't think it works that way. Especially at a restaurant, right? I mean, you want everything killed. So I think it's probably, off the top of my head, it's a low cost, high certainty of kill, recurring type business. So that's what I think people care about there. I doubt they're price shopping that much.
You don't think so for termites? I'll bet if you open up the phone book, there's that phone book is a thing that used to exist before the internet. If you went and if you went and Google searched Terminator, termite terminators in your area, there'd be 3 pages of them.
Yeah, but maybe this guy buys, maybe the big guy buys all the ads.
Buys the advertising. Then where does the value for that flow? Does it flow to the termite guy? Does it flow to Google?
I think Google's the tax on everything these days, as is Facebook.
That means you got to own Google, right? Google at any price.
Gap.
So, gents, other topics. What have we got?
Well, one thing that came up during this weekend that was kind of a fun, call it a game, and I'll see what you guys have to say about this. But here are the ground rules for it. And maybe if you're, try playing this game with your friends and see what they come up with, and maybe we can crowdsource what's a good answer to this, because there were some very unsatisfying answers that we came up with. So here are the rules. You're allowed to pick any security, long or short, I guess credit or equity, and no derivatives, no options. But here's your goal. You have 1 year, and you have to get the lowest possible return that you can get. Lose the most money. Ideally, you go to zero. Okay. Sounds like it would be easy, right? And this is why it's interesting, is that it's really trying to get to Michael Maubuson's idea about, when you try to determine luck versus skill of something, if you can fail on purpose, then that means maybe there is some skill involved. So you think of a roulette table, I could try to lose by putting all my money on one of the numbers, and I'm likely to lose, but I could also win really big. So there's the rules. What do you guys have? Bill, why don't you start, since you kind of already answered a little this weekend?
Yeah, I mean, I probably go to a levered minor or something like that. But
long the levered minor.
Yeah, that's right. But with my luck, they end up getting a bid, and I end up 6x, and then it's like a Brewster's Millions type problem. But we were talking about, I think the tough thing about this is it also hits on the second order thinking, right? It's easy to say, well, I just buy this piece of crap, but that piece of crap is priced like a piece of crap. And if something changes, you're going to have a lot of money that you got to blow in the next, let's say it takes 6 months. You only have 6 more months to lose it all. And I think what we were getting to is over the short term, there's a lot of luck in this game. What do you say, Toby?
Yeah,
well, I would add that it means almost literally 1 year's results are meaningless.
Yeah,
completely meaningless.
The issue, so if you had, just taking the roulette table example, like you can have the win, but if you can play all day long, every day for a year, you can vaporize that money, right?
Yeah, that's true.
You could grind all the way through it because the VIG and you're getting a return that's less than 1 all the time. I think I don't have to trade it, but I think that if I could trade it, I can get you much closer to vaporizing that money. You know, I've got a short screen. I've got things that I think are going to go down. But that does illustrate one of the problems that Bill brought up then, that you do have to have, you're looking for stuff that's overvalued or, you know, is mispriced anyway. Yeah. And that's the problem with investing. A lot of stuff is pretty well priced. Even the junky stuff is it's accurately priced. I'd be going through that short list of short names, and I'd be buying them long, buying one of them long, and then I'd trade them more regularly, because I think that, you got zero cost trading now, right? That you can really set yourself on fire with that. Yeah, it's hard, but I do think that investing is a game of skill, and I do think you can lose over the course of a year, and I think that's some proof that there's some skill in it. I think that there is an enormous component of luck, though, which is what makes it so hard.
Well, there's definitely, I mean, I think what we were talking about is, like, there is certainly skill over a 5-year time horizon. The 1 year, I think we were backing into almost
depends
our
on those 5 years, though. Like, let's say 2009 to 2014, did you need a ton of skill to make money?
You needed guts, right? I mean, a lot of people were hiding.
Yeah,
that's very true.
Which I think that's a learned habit, right? I think a lot of, I mean, certainly me back then, right? I mean, I was an amateur back then. I was a lot more afraid than I think I'd be now.
Okay, how about then 2014 to 2019? That might be the better sample.
That's a hard one.
Yeah,
was that luck or skill?
I guess we'll see, right?
I think that period is an interesting period because. You know, the value, I don't want to say factor because factor's price to book, but the guys who are like me, who are buying more on yield, care less about growth, definitely have not performed very well through that period of time. If you're somebody who leans a little bit more heavily on growth, so if you're trying to pay growth at a reasonable price or that Buffett compounder style, then I think it's probably been quite a good period for you. I don't think you've done quite well.
Yeah. Well, I think what those guys probably did well in aggregate is realizing that the path of distributions was mispriced. I guess the tough thing about that is, as that thesis gets proven out, the world gets priced in a rosier and rosier way, and eventually, you know, there's not a lot of
you start being right for the wrong reasons now.
So you're saying that was this fundamental change wrought by the internet, where that marginal cost, that marginal sale was at zero cost or virtually zero cost. That's the software as a service or anything distributed over the internet. Yeah,
I mean, I think what certainly I missed, I don't know about the market or whatever, but is just how much margin inflection was on the horizon and how persistent that would be. And, you know, some people saw it, and then some people probably got lucky, right? But they're not all lucky by any stretch. The question is, going forward, what's the right bet? Because, you know, anyone can know what the history said.
So my answer to what I would try to do is I thought about how could I find like one particular thing that might change that I would be very highly levered to. So for me, I got to thinking, all right, I want to be long the most ultra like duration that I can get. So I would short the Argentinian century bond. And it either is going to work spectacularly or totally blow up in my face. But I'm basically making a huge interest rate bet as much as I can and hoping that changes somehow.
If you're a macro investor and you had, so let's say you don't put 100% of your position into this, right? Let's say you put, I don't know, some sense like 1 or 3%, something like that. And then you build out a whole portfolio of these things. Because that's such a contrarian bet, I'll bet there's almost nobody in the world who thinks that that's a good trade, right? So it's probably...
Well, what's ironic is that actually I might also take the Argentinian century bond as my bet.
Well, that's
what a straddle. You're just betting on vol.
You're betting on the move, yeah.
Either one of those has probably a decent chance of being such a crazy vol that maybe it helps you win.
The thing you have to, the only way that you win on that though is if the vol is too low. If the vol's already in those prices, then that catches you. That's why it's such a hard game. It's the expectations game, right?
Well, that's where people get crushed in options, right? Like I'll have friends that'll be like, "Oh, I think this is going up," and I'll buy the calls. And I just say to them, if you don't know what the term vol crush is, you should stay as far away from options as humanly possible, because there's nothing worse than being right and losing your money.
Which is an interesting point that you bring up, because the VIX, the index, has been it's trading at close to all-time lows. I think somebody's thinking about taking it private. It's been beaten up for so long, and it hasn't done anything.
Is KKR going to do it, an LBO on the VIX?
But I think it's one of those things that, like, when VIX gets beaten up like this, and you can go and get the vol calls are cheap. VIX calls, front month calls, they're all cheap. They're all like thrown away at the moment. You can pick up some of that stuff, and probably you're going to throw them away. This is the old Taleb strategy where he'd be trying to short closer to the mean, closer to where the price is, and he'd be long further out in the tails, which means that you lose money most of the time, but you gain it all back. Like every 7 years, you get the 1,000-year storm. Anybody playing that? Anybody doing that?
It's not how I'm going to run my money, but I like the theory.
I've done it. I've thrown away all my money that I'd put into it, though.
I've experimented with that as well, and I like the bet. I don't think, and it was 100% loss on all of the money that I did that with, but I still don't think it was a bad bet at that time. I thought it was very mispriced.
Well, to be fair, the odds are such that it should be 100% loss, right? You're not really betting on getting your money. The expected value of the bet may be correct, but that one particular bet, the expected probability is not good.
You have to work out as a proportion of your portfolio what you're prepared to lose on it every month or quarter, or however you're positioning the bet, so that over the course of a year, you burn 1 or 2% of your portfolio, knowing that at some stage there is going to be a big bust and you're going to capture it. The problem is I did it pretty consistently, and I caught two big busts. I caught the 2018 one, and there was an earlier one, I forget now, 2016 or something. In both instances, these things were explosive. Like, they were rocket fuel. This is just in my PA. This is not anything I'd ever do professionally, but they were like, in both instances, they got up to something like 30% of my portfolio value, starting out from 1%. Here's the problem. In both instances, I wanted to hold them through to expiry, which was like, at the end of the month, which was only like a week or two in both instances. And in both instances, they expired worthless.
Wow.
That's the problem with those European style options, that they expire only on.
Well, you can punch out of them. You can sell out of them.
Yeah, but the problem is that the people, the market, I think it goes back to psychology, actually, of like, you will take a gamble to try to avoid a big loss, but you won't do that for the gain at the same way. Like, it's kind of loss aversion. So they will see that, like, they maybe have this really big payment coming if that was to expire and they were on the hook for it. They'll roll the dice, and so they won't buy themselves out of the position. Like, they won't hedge. The hedge would be it being closer to what you would want to get for being on the other side of the trade. Does that make sense? The volume
does pick up as they move into the money. Like, they become much more liquid as they move into the money. So when you buy them, like, if you buy them out of the money, you buy them like 2 or 3 standard deviations out of the money. and they're basically illiquid. Like you can't roll them. You're in them until you sell them. But if you get a move where the VIX approaches your strike or goes through your strike, they become very liquid at that stage, and you can sell out of them. Just in both instances, I was thinking this is a hedge, so I'm not going to close out this position because I'm still long everything else, and I'm trying to get longer on that side. But in both instances, like after being well in the money, that January 24, I was that was looking like a pretty good Christmas, but that was the absolute pinnacle. And then they expired like 21 January, and they expired worthless over that period of time.
Oh yeah, so, especially with this B bottom.
Right.
Yeah, that was a sucker punch there.
Looked like value was going to start working then too.
It has.
Well, that's the part of them that I always found attractive, was that I was going to be granted a very large amount of capital right when I really wanted to be able to put it to work.
You get that third pocket.
Yeah, that's appealing to me.
If you take advantage of it in the sense that you start investing longer and then they expire worthless, I don't think you've lost out in that. Even though I'm upset about the fact that the call expired worthless, and I would have made a lot more money if it hadn't, but I was at least buying stuff longer in my PA that I may have been nervous about, but I was like, oh, the PA's kind of like not, the PA's up a little bit. I should be buying some more stuff here. It should be getting longer. Unfortunately, I was buying value stocks, so it didn't work out quite as well as I hoped.
Double whammy.
And none of it was Apple, because I thought Apple was going to get cheaper.
Eventually, they were going to buy in their own shares. They just have too much cash.
Well, that's the funny thing about Apple, that it goes through that 3-year cycle where it's mid iPhone and everybody thinks, oh, it's all over. And then I bring out a new iPhone. It's all good again.
I still don't think, it's not like particularly rich here. But then there's the part of me that's like, it's also $1 trillion company. Like that's objectively a big number. Yeah.
Right? 1.2.
Yeah, but then they got like, 100 million of cash or something like that. They got 53 billion coming in every year. It's the cash. That thing is a cash machine. It's incredible. Even at this valuation, they can buy in 5% of their market cap every year, which is like sort of hard to fathom.
Do you use an iPhone?
Yeah.
Do you use an iPhone, Jake?
I do.
I'm on an Android. I refuse to get locked in.
This podcast is over.
Yeah, that's
it's being recorded on a Mac.
We're not going green with
Mac.
this podcast. No, I'll tell you what I found really interesting the other night. I was watching the morning show, the Apple show that they, with Jennifer Aniston.
Is it fiction or is it what is it?
It's fiction, yeah.
Okay.
Yeah.
It's not like an actual morning show.
No, it's
sorry.
It's okay. So anyway, it got me into the Apple TV ecosystem again, right? It did what it was supposed to do. And then there's this little icon for Disney Plus. And I was like, oh, I'm a shareholder. I'll definitely buy Disney Plus through Apple. I click on Disney Plus, and it diverted me to the arcade app. And I was like, this is not at all what I want. And it blew my mind that they're spending all this money to get me back into the ecosystem. I'm back there, and then it felt like so gimmicky and not very Apple to get me into the arcade. Just to say like I've signed up for the arcade and they have X amount of users. It just, I don't know, something rubbed me like really wrong about that move. And let's say it was a software glitch, that should not exist. It's Apple.
Well, if there's been some problems with the streaming, right? They didn't get the streaming right.
Yeah, but I think this is an Apple issue, not a Disney Plus issue.
Well, I heard some issues with Disney. You think so that the streaming was an Apple issue or the streaming was a Disney issue?
I didn't even get to sign up. So it was like it was as if they were diverting me to sign up for something before I was allowed to sign up for something. Or or it was a software glitch. I don't know what. Either way, it did not just work, so to speak.
I saw a lot of discussion on Twitter over that period when it was supposed to launch of people who couldn't get in and they couldn't watch what they were supposed to be able to watch. I didn't sign up until after that all went through. I have signed up now because I wanted to see The Mandalorian, which is excellent, by the way. Surprisingly good for a Disney Star Wars type movie.
I saw a guy watching it on the plane, and I almost looked over his shoulder to watch it. I
It's
decided
pretty cool.
not to be.
It's the best Disney Star Wars movie that I've seen. Like it's a TV show. It's like a half-hour episode, but it's much better than any of the other new stuff that's come out. I think the first of like the episode 7. Does that make sense? Like, not the original ones, not the reboot from 20 years ago, the reboot from like 5 years ago. That first one was great because it was like a throwback to the original stuff. The second one was unwatchable. I couldn't tell you what happened in it, but The Mandalorian's pretty good. It's interesting.
I'll be signing up soon. I mean, I have kids that are right at peak Disney age, so
me too.
They've got me for years.
It's pretty cheap. It's like $7 a month, or they say you can get the whole year for $70. I was like, all right, I can do that math in my head. I'm a finance guy. I'll buy the whole year. So, Bill, what's your topic? What have we got?
I've been thinking a lot. One of the concepts that came up was if you think about like where you're going, right? Kinetic energy, the formula is 1/2 mass times volume, times volume. Yeah, right. Times velocity squared. So like in that equation, the speed or velocity is much more important, but velocity is speed times direction. Right, so you've got to make sure step 1 is go in the correct direction, and then step 2 is the speed that you are going in the correct direction is more important than whatever size you are at the time. We discussed it talking about Berkshire, and I thought that was a pretty interesting way to think about the idea that. Maybe they've always in their head been like going in the right direction and then sort of accelerating and slowing down as the time sees fit, but they've done everything that they can to not let the mass sort of drag them. I don't know if I messed up some of that, but that's sort of how I'm processing it.
I haven't done physics since grade 12, so they might have to lean on the electrical engineer. Are you an electrical engineer?
I am not. No,
not
the person that said it is the person that had the thought. I am merely reflecting on the thought, which is why I said volume and not velocity.
At least you didn't say volatility.
That's right. Yeah.
No, it is an interesting concept. I'm not entirely sure. Like, that's sort of it sounds like you're reasoning from first principles, but it almost maybe still be like reasoning by analogy in some ways, but it is an interesting concept, and I do think Berkshire represents it pretty well in that, one thing of, like what's the number one rule of investing? That's kind of like, don't lose money, and then that's sort of like don't go in the wrong direction. And then, a lot of things that Buffett will say will be like, play center court, don't push towards the line, not too much leverage. All those things are in the effort of not kind of going in the wrong direction. So, yeah, I think it makes a ton of sense myself.
And it's interesting, like you look at Fairfax, right? And this could be resulting, but, that hedge, like it really set them back. And I think a lot of people, it's almost tainted, what is otherwise a really good career. I don't know. It's just interesting. Avoiding the big loss is just something that I've been ruminating on since this weekend.
It makes me think of two things. One is that Rentec Jim Simons, I hope I'm saying it, Simmons or Simons. How have they done that? That's insane. Those 70% pre-fee for 25 years. Is it longer than that? That's bananas.
Yeah, it is.
Are they paying out all the capital? How are they doing that? It's not compounding, surely. It's bigger than the stock market now if it's compounding.
Yeah, I think they kept it trimmed at a pretty small level. And I think if I understand it right, and I maybe I don't, but that number that you referenced was for their internal, like, employee, and not necessarily Reef. What everyone else got.
Which is Reef, right?
Yeah, so I don't know how they did it. There was one funny thing I saw, I think it was in the Wall Street Journal, that they asked some of the guys there, like, the money had to kind of come from somewhere, like who was on the other side of all these trades. And one of the guys, I think maybe being a little more diplomatic, said, it's probably, traders who were making bad choices or, not being decisive enough or whatever. And then another guy said, yeah, probably a lot of dentists.
Yeah, that's right. Yeah.
We just took all the dentist money.
Yeah.
Do
we
they have
fleeced
do they have that
retail.
much money?
I don't know. I mean, I think dentists do pretty well, but
I mean, I don't mean the dentists specifically. I mean, is there enough kind of retail churn out there for Medallion to make that much money?
I have no idea.
well, that's why I would probably take the under going forward on doing that again. Because I think I think just like the actually Malboson was talking about on your podcast with him on the Acquirers podcast, and he was talking about how like the poker games when it got popular in 2003-ish and all these new people started playing and all the sharks had all these minnows to feast on, and it was like the heyday for poker. You could probably say that was pretty similar to maybe what Rentec saw. And then, all the minnows get eaten, and now all that's left are sharks swimming around trying to eat each other. And maybe that more accurately describes what with so many people opting out to index, they're kind of taking their chips off the table a little bit for the other players that might have been feasting on them before. So
even Jack Ryan, did you see that?
I did, yeah. What do you see? Like someone asked
in the
him
new
for a
Tom
stock
Clancy,
tip.
yeah, give me a stock tip, Doctor of Economics, and he says get a low cost S&P 500 fund. That was great advice 10 years ago. I think that's not great advice now.
It's tough to look at some of these things and think I'd want to own a lot of those.
I mean, you get them for basis points though, so there's that.
There is that. You might be worried about pennies and missing the dollars, though. I'm not sure.
One of the
But
things
I am biased, right? I believe in active, so.
Yeah, so do I. I think if I work the problem backwards, like if you go to construct a portfolio, would you build a portfolio like the S&P 500? There's just no way in the world you'd do it that way.
Right.
At a minimum, you would at least like equally weight or something. I mean, the market cap weighting to me seems really dumb and discriminates against some things that you really want, like high insider ownership, maybe, or at least like some skin in the game. The fact that Buffett has call it 20 or 25% of Berkshire takes that out of the float completely. Therefore, less liquidity, therefore less representation in the index. Well, that's kind of boneheaded. Like he has skin in the game here. I want to be on his side more. So I don't know. There's definitely a good idea taken too far can lead into stupid behavior.
I think it's less egregious now than it has been at various times in the past, because there were, in the 80s, I think, XOM, that's Exxon, isn't it? Am I losing my mind? XOM was 40% of the index. So do you want a gigantic oil company? Would you hold 40% of your holdings in XOM? You wouldn't. No way in the world, unless you've got some high conviction view on what the oil price is doing, which I don't think really anybody does. Now, I think
there was a funny story from Canada actually, when in the .com, like Nortel got gigantic, and it was probably like 30% of the index, and all of the fund managers who didn't have enough of it in there because they couldn't keep up with any index unless they were just absolutely super long Nortel. But then after that completely blew up, the managers were kind of like patting themselves on the back, like, look how much money we saved everybody by not having you in Nortel. But what it was is that they could only own 10% in any one idea or any one security in their mutual fund. So they couldn't keep up because of that regulation. But then they, when it blew up, they took all the credit for not being so long Nortel.
Having some risk limits in the portfolio.
Yeah, exactly.
I think one of the theories that I have heard about the .com boom was that all of these .com stocks, they were pretty low float. There just wasn't much around. So when the indexes kind of tracked them going up like that, it was, I don't know if you remember the Janus funds. They would like jam them. They were very big funds that would jam themselves into these small .coms and blow the .coms up, and then keep on buying into the .com. And it was like this self-reinforcing.
Wasn't that Oakmont Stratton? Didn't they do the same thing?
Yeah, that's the Wolf of Wall Street, right?
Yeah.
But I think the Janus Fund thing that was a real one, and those guys were kind of heroes at the top and zeros at the bottom. And I think that was like a microcosm of what was happening in the index, except it wasn't just one fund; it was a whole lot of funds pushing in. And so apparently, that's one of the arguments for the rise of passive being a dangerous thing, because as these funds become bigger and more of the market moves to passive, that they push, that has this huge distorting effect on the markets that now the active guys can't ever kind of push the markets back into order. I don't like that. I think it's a bad argument, because I think that if active survives on distortions, you want as much distortion as you can possibly get, right? I want stuff left behind.
Well, I think it goes back to Keynes about, can you stay, solvent as long as, or you can't stay liquid as long as the market can stay irrational. And so if you have every person who would be paying the right price is just getting dominated by the flows that are happening, it's, if they go extinct, then how many of them are left to fix it? I don't know. It's an interesting argument.
But I wonder if you do, like, if you're just a long only manager and you're picking up, if you can get a 10 or 15% yield on these big stocks that are still growing and doing pretty well, do I care whether anybody else is buying them or not? Probably not, right? Like, that's part of being a value guy, is not expecting to see performance in the names that you hold, trying to get the returns from the underlying performance of the business.
Yeah, you just want a rational capital return strategy, right? I mean, the thing that drives me nuts is, these companies that are like, yeah, we're going to buy back shares. It's at any price, right? I mean, like, what does that mean? But yeah, to your point, I mean, if you buy it cheap enough, as long as management understands how to get it back to you in a reasonable way, it should not matter. I mean, it shouldn't matter if the market's closed, right?
I kind of like the fact that there has been, I think that there's a little bit of a resurgence of buybacks in certainly the names that I follow. So I hold ConocoPhillips, like, that's announced a $3 billion buyback. And I hold, name's just escaping me. HPQ, which has got Carl Icahn. He owns Xerox and he owns HPQ. He wants them to combine. HPQ, they've forecast $3 billion in free cash flow for 2020. You can buy it now for an enterprise value market cap. There's virtually no debt, $30 billion. So that's a 10% free cash flow yield plus a $5 billion buyback announced on top of the 1.7 they've already got outstanding. Like, if that doesn't move the stock, then nothing moves the stock.
I mean, that's probably the best thing that you could hope for your basket of your style of EV to EBIT, buying back at cheap levels of that. I mean, there's probably nothing else they're going to do that's going to move the needle as much, right?
Well, I kind of hope that there's going to be, I'm trying to buy these things at a business trough, so I'm hoping that I'm getting some upswing as the business comes back to them a little bit. I appreciate that that's harder to do than it is to say, but that's the idea. Like, if I look at the historical growth in my names is terrible. It's like 4 or 5%, so it's a little bit better than inflation, but the forward growth is pretty high. Like, and this is like looking at their reinvestment rate, looking at how much money they're making, how much they're reinvesting. That's how I'm interpreting the forward growth. Like, the forward growth is like 11 or 12%, which I think is, I'm kind of hoping that 10% free cash flow yield, 11 or 12% in reinvested growth. That should, like, if that doesn't work, then value investing doesn't work anymore. Like, that's my definition of investing.
So that's interesting that you're using their reinvestment as a, so, I mean,
reinvestment times historical return on investment.
Okay. That makes more sense now. I was going to say, you're just assuming that return on investment is kind of equal across the universe, but no.
Well, I'm saying that their historical return on investment is a reasonable proxy for what they're going to do forward. Like, I don't actually know if that's what they're going to achieve, but that's what I'm kind of hoping, that if you reinvest this much in your business, you've got some maintenance capex, you've got some growth capex, but you should be able to maintain your return on invested capital across a year or so. And so I can get a pretty good idea that they at least will be growing. Whereas I look at some of these expensive companies, they can't buy back much stock because they're just too expensive relative to the size of the business in there. And if they're reinvesting at these rates, like they're kind of chewing up capital.
I mean, I'm a dinosaur, but some of these SaaS names, the software as a service. The thing that I wonder is, especially when it comes to enterprise, like to me, a lot of that game is the quality of your sales force. So it's like a sales and distribution game. And let's say the market starts to care that you're spending as much in SG&A as you are in revenue. And you start to have to cut people. And then does your stock get re-rated on an earnings multiple? And then if that happens, like, do your sales guys just look around and be like, what am I even doing here? There's other jobs that I could get and, get different. Because at some point, your stock comp almost becomes demotivating, right? If the price is so far out of the money, what are your options really worth? It's just, fairy dust. So, right? I mean, it's
you went to work.
Fine.
You went to work there to probably in those situations to leave with a very, very healthy amount of equity in that company, right? Or
change the world.
Right. So, yeah, it's to change the world.
Well, I think this is what Greenblatt is getting at when he says some of these are going to be what people are pricing. All of them are not, right? So out of that basket, there's a pretty high degree of certainty that you'll underperform. And that's why, on my Twitter feed and whatever, I just tell people, know what you're doing, right? I mean, some of these guys know exactly what they're doing. And I'm sure that I'm not sure, but I would bet a higher probability that they will be fine in that game. But like me, I would just be donating my money to these people right now. I mean, I don't know what the heck I'm doing in that space.
Isn't
trying
that kind
to
of
learn.
That's the when you see all the data on, here's what glamour stocks or growth stocks or whatever you want to call the most expensive decile, here's the value stocks or the trash stocks that nobody wants to own. Value pretty consistently outperforms growth. Hasn't been true for the last decade. But and people say, well, why, if you look in that historic, it's worked over the last decade, so it's easier to make the argument. But historically, people would say, well, why would anybody buy the most expensive ones knowing that they don't perform that well? And it was this behavioral argument that all of the really big winners, individual winners, came out of the expensive
that population,
stuff.
Right?
So, there's companies like Walmart. Walmart just never got cheap through its entire, the 25 years that it grew insanely. Microsoft never got cheap through the 25, 30 years that it grew insanely. Amazon, never cheap, just always grew insanely fast, always was optically expensive on a ratio basis, but always growing just so rapidly that you just could never find a way to rationally value it. You just had to trust that it would outgrow the overvaluation that it apparently had at the time.
Which, by the way, anyone that thinks that they could have held Amazon, go read Brad Stone's book and really think about all the executive departures and all that stuff and tell me you would have held.
You had to foresee AWS.
Yeah, right. I mean, basically, the only one that held was somebody that said, I love Bezos, and I'm just going to let him do what he wants because he's a genius, which, turned out to be right. But I fundamentally disagree with people thinking that they could have watched that day to day and been like, oh, yeah, I'm fine.
It's fascinating because you find that Amazon dominates so many investment conversations these days. Everyone talks about when they're looking at a business, well, could this be affected by Amazon? And I don't remember a time or another company where it was that kind of apex predator that everybody worried about.
I wonder if Sears was. I mean, and I know that sounds silly, but Sears had quite an organization back in the day.
They did.
Sears was the Amazon of its day, right?
Yeah, I mean, that's from what I understand. And I mean, I don't know all the entities that were spun off, but I think if you follow the Sears spinoffs, you'd be like, whoa, I didn't realize that all that came out of it.
I agree with the retailing component of that and, some of the manufacturing stuff, but
they had a financial division. I don't know.
All right. Yeah.
I think it was an impressive organization.
Oh, no doubt. It was an incredible organization.
We've got a question from a listener wants to know, this is Austin from Melbourne, is it important to understand if a company's revenues or profits are sustainable or overstated, understated due to boom or bust conditions? If so, how do you go about this? Is it important first?
My man, I would say that's the entire game. And if you figure out how to do it, let me know. No, I mean, I do. Like, if you think that you're in a boom time, you better be paying a trough multiple. And if you're in a trough time, you can pay a rich multiple. And I mean, it's. I think that's a pretty hard question.
Is that a market question? Is that a sector question, or is it specific to the business?
Well, I'm talking about
all of the above.
That's right. Yeah.
I think that Eric Cinnamond, who I talked to, has an approach that sounds more like Graham's, where you go through and you average the last decade. That takes out the business cycle. Then you're trying to buy at a discount to the average earnings. The problem is we tested it in quantitative value, taking averages from everywhere from 1 to 8 years, and we didn't ever get better performance doing that. So it's a really, really hard question. I think in an individual company, you want to be trying to buy close to you want to pay a trough multiple on trough earnings. I think that's super hard to do.
I think if you read Edward Chancellor's Capital Returns, that maybe gives you the best chance of having a framework for understanding that capital cycle theory. Doesn't make it easy though. I mean, even though you know it, it's still really hard to recognize what is cyclical and what is secular.
Well, how about this? Why don't we work backwards? We could say you don't want to buy a commodity in a boom time, right? You don't want to pay a peak multiple on a high price for a commodity. So any company that's cyclical like that, you have to be very, very careful. As for other companies that are kind of not necessarily commodity inputs, then that's a more difficult question, right? Are you paying a peak price? Do you assume a kind of trajectory of growth? That's a much more difficult question.
Can entrants come? I mean, the thing that Jake and I always joke about is everybody talks about TAM, but nobody talks about TES, which is total eventual supply, right?
So that's total addressable market. Everybody talks about how big the market is, but nobody talks about their competition.
Yeah, and what can go on with it. And that's that capital returns book, right? They sort of look at the world backwards and say, okay, well, what are supply constricted industries for some reason or another, and then work into what they want to look at. So that's a great book. People should read that. So
I think we've we've given all of our thoughts on it, which is we're pretty limited on that question. So that's a good question. Thanks, Austin from Melbourne. Now, if folks want to get in contact to further illuminate any of the questions that we've talked about today, or to submit questions, Jake, Taylor, how do they get in contact with you?
I'm pretty easy to find online. My email's not too hard to find if you want, but also Twitter's a good place to find me, and I'm at Farnam Jake 1.
And I'll stick that in the link to these notes. And Bill Brewster, how do people track you down?
Always on Twitter, at Bill Brewster SCG, as in Sullimar Capital Group.
And I'm Greenbacked, GREENBACKD on Twitter. Also Greenbacked at Gmail if you want to shoot through to send me an email that I can read out on this. Gents, that was our first one. What do you want to score us for that one?
I think it's better than a 5.
Out of what? Out of 100?
Out of 10.
Out of 10.
I had a good time. I hope somebody enjoyed listening to something we said. It's going to get better. I had a good time.
I would give us a 7. I think it'll keep getting easier to not step on each other's toes as well, because it's a little bit of a lag sometimes when you're recording these things, and you don't want to talk over somebody. So, but we'll get it figured out.
I think for a first effort, I think it was pretty solid. I think I'd give us a B+ for our first effort, but we're shooting for an A+, and so it's going to get better. Thanks very much, everybody. We'll be back in a week.
Move with the rhythm, shake it up, stop when the clock hits 13. Sing one.